Market volatility is real. It's inevitable. But here's what most people don't realize. You don't have to experience the full brunt of it. There's a difference between accepting that volatility exists and building a portfolio that protects you from losing sleep over it. Here's what happens to most people. The market drops 10%. The portfolio goes from 500K to 450K. Panic sets in. They check their account 5 times a day. They can't sleep, and eventually they make an emotional decision, selling at the worst possible time. But here's the thing, that panic isn't just a psychological damage, it's financial damage. From 1993 to 2023, the S&P 500 returned about 10% annually. But if you missed just the 10 best days in the market over those 30 years because you were sitting in cash after panic selling, your return dropped to about 5%. That's more than half your wealth gone because of emotional decisions driven by a portfolio that wasn't built to handle volatility. The question isn't whether volatility will happen, it's whether your portfolio is designed to protect you when it does. The traditional advice is simple. Just stay invested, write it out, don't look at your account, and yes, historically markets recover. The 2008 financial crisis recovered, the COVID crash recovered, the dot-com bubble eventually came back. But that advice ignores something critical. Not everyone can afford to just write it out. Not everyone has 10 years to wait for a recovery. And not everyone should have to white knuckle through a 30% drop hoping they don't panic and sell at the bottom. What if, instead of just hoping you can emotionally handle volatility, you built a portfolio that reduced your exposure to it in the first place? What if you had protection strategies in place that let you sleep at night, even when the market is tanking? That is where strategic planning makes all the difference. You can build downside protection into your portfolio without sacrificing growth. That might mean using insurance products that guarantee a floor, so even if the market crashes, you know a portion of your wealth is protected. It might mean incorporating annuities that provide stable, predictable income regardless of what's happening in the market. The goal isn't to eliminate all risk. That's not realistic. The goal is to structure your assets so that you're not fully exposed to every market swing. You keep your growth potential, but you remove the scenarios that cause people to panic and make terrible decisions. Think of it like this. You wouldn't drive without car insurance just because most days you don't get in an accident. Protection isn't about what happens when things go right. It's about what happens when they don't. Here's what this really comes down to. You can have a portfolio that grows over time without losing sleep during downturns. You can participate in market upside while having guardrails that protect you on the downside. The investors who stay the course aren't always the ones with the highest risk tolerance. They're the ones whose portfolios are designed in a way that they don't have to test their risk tolerance in the first place. Market volatility is inevitable, but experience the full emotional and financial impact of it isn't. The difference is in how you build your plan. Protection isn't about fear, it's about smart risk management.